Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for December 1st, 2012. We have a market that has returned to bullish normal. On an annual basis, using weekly RSI 14, we're at 55 out of 100, or middle of neutral. We're at 109 on the 10-day NDX, so short-term the market is overbought. Percent stretch relative to the 200-day moving average is at 3.18%, so we improved by about 0.6% for the week. That still leaves us red bullish. Slope of the 50-day moving average has improved to minus 0.29% and remains red bearish. ADX 14 is a neutral trend at 16.8, the balance between bulls and bears. And relative volatility at 1.17% has gotten smaller and back into normal territory. Next reevaluation of the blended monthly rebalancing is on or about 1 January. The 26 ETF.
Dogs, knock it off.
The 26 ETF portfolio is holding China, Europe, and Asia less Japan. 13 ETF is Asia less Japan, Australia, and the Euro-Asia blend. The theoretical model in ETF2, this should read at 80%, and the model portfolio will be at 80%. Quick review of the 13 and the 26 ETF. You can see starting to dominate again with the buys over the cash positions. The market health check, excuse me. Vertical blue lines represent 10, 20, and 30 days of look-back period. The horizontal purple line is the swing high that was achieved back in October at 147 and some change. Vertical red lines are places where price has found support previously. Central black line is the 30-day regression line. The outer black lines are the channel formed by the maximum excursion from that regression line. You can see that was hit on the lower end at middle of November. And we've come back into the river, which is the 30-period Bollinger Band plus or minus 1 standard deviation. We've cleared the Bollinger Band mean, are back to the 50-day moving average. The 10-period moving average has rolled up, and we're near the top of the channel. But Friday closed in a doji for a nice move off this swing low. That would be a normal first leg up, and this would be a natural place for it to go sideways, find some support, or preserve some of these profits. The next key price level, 140, a close above 144 will tell us this is still continuing. A close above 148 that holds will be an important, the first important signal of a longer-term bullish move continuing, and then we'd see this as a long pullback to support. You can see the 5 and the 10% price pullback levels. We never got out of the correction zone here for the bull. Although we did dip into the just below the 200 period moving average, which is the thick red line in the red shaded area. We've been overbought for about 5 days, and PPO once again was an excellent intermediate term alert when the positive crossover happened here 2 weeks ago. Jaws are still opened and pointing up. So bullish normal. Has made a significant bounce off of the swing low, but this is a natural place for that tactical move to end up and start to stall. So we'll see what's in the cards. Perfect place for a tactical trader, because you can there will be ways to frame this trade as a 2-to-1 as a retest of the high or the swing low. Right now the signs are still pointing downward. Again, we're 80% and 20% in the theoretical model. EFA is still stronger than SPY. EFA is at 64, SPY is at 61. So it's the global better than the U.S. right now. Inside the U.S., it's mid caps, then large caps, then small caps, then technology. Two strongest sectors, Europe and Asia less Japan. The two weakest are Latin America and Japan. Quick look at the world market model. You'll see most of the U.S. is below average, mid caps and select value or high, or above average, excuse me. Anything Europe is excellent right now. Selected Asia less Japan is excellent, with India, Australia, and Hong Kong leading the way. Asia less Japan aggregately is strong. Mexico and Canada are above average. Brazil lagging behind, but starting to close. A bit of a pullback this week in gold and silver. In the business sectors, it's still financials and industrials leading the way. The defensive plays, staples, utilities, and healthcare, not as strong. Quick look at the ETF top 30. China real estate, U.S. home construction, buildings, Spain, Europe, Hong Kong, Germany. Again, it's the non-U.S. and then specialty sectors like real estate. The Dow 30 based on the same lens but sorted by the strength column. Financials at the top, Bank of America, JP Morgan, Travelers, then old reliable Home Depot. It just continues to march. Hewlett Packard, as usual, at the bottom, with Intel, DuPont, Microsoft, and AT&T near the bottom. I still look at McDonald's as a potential value play here. Coke has found its way back into the top, moving towards the top. ETF liquidity, just a quick look at the top 30 ETFs based on average daily dollar volume and then their respective volatility. Those in green are ones that are excellent intraday traders because of the combination of liquidity and volatility. We will leap ahead now to the daily report. Let's take a look now at dial into the gap stat over the last 30 days for symbol SPY. 14 times the market has gapped down in the last 30 days. 5 of those gap downs have continued to fail for a minus 0.95 average follow through. 9 out of 14 times it has reversed to close higher for an additional 0.32. 16 times the market has gapped up. 7 of those times the gap up has reversed to close lower at a minus 0.71. So still, the failures intraday have been larger than the gains intraday after the open. So it's been a fade the opening gap kind of a market for the last 30 days. No signals in overreaction or channeling. You can see the volatility starting to chill now that the election is over. ADX continues to decline. It's a toss-up between bulls and bears right now. The winners, the 10-day min pains in the Dow, Pfizer, United Health, Verizon, Coke, and Disney. 10-day max pain that are good opportunities for value plays for swing and intraday trading. Intel, Microsoft, Hewlett Packard, IBM, and DuPont. In the ETFs, it's been the VIX, natural gas, gold miners, gold, and then another form of gold here. Channeling and overreaction signals in natural gas and gold. 5 days down for natural gas. In the auto framer, it's Cliffs Natural Resources, VIX, and natural gas. Very few patterns, a handful of dojis in the Dow 30. And you can see Home Depot is just marching along, been just the absolute dominant play in the Dow. Bank of America also pulling some excellent numbers here. No patterns much to speak of. In the Dow 30, natural gas and gold in the channeling and overreaction. 5-day down in natural gas. You see the VIX tests out at over 6-1 on the reward to risk auto framer. And quite a few symbols you see highlighted in green. That means they closed higher than their previous 10-day range trading high. So big plus ups in those. Thirty-period regression line in the market mosaic indicators. You can see ending in a doji. So at a natural pause, that's the last place that it achieved before it failed big time. My expectation is upward though. We've seen the regression line crossover now, the 30-period regression line crossover. It's 10-period moving average at a distance of more than one standard deviation from average. That's always been a reasonable way to get early warning about a change in trend. You can see it zoomed in here over the last 30 days. And the percent stretch above the 200-day moving average, you can see, has moved over standard deviation up. Still has a standard deviation to go to get back to the 6-month average. The z-scores of the regression line slopes, the 10 has come out of the river already and is rolled over. The 30 period has reversed from an extreme position and just entered the channel, so there's still more room for this to go. And if the price were to get back up to the top here, around 145 of this previous channel, then we would that's what it would take to get this regression line all the way back up. You can see almost the sine wave looking 90 period regression line z-score, how smooth that is as an oscillator, and it's back to the 0 line. If it were to find support here and go, then that would take us above 148 and into new bullish territory. You can see price now with respect to the river. It has the extreme move out of the river has come back to the mean and a little bit more. We still have to contend with this downward trend of the channel. This would be a short pullback, but then we've seen that the last time that it came to the 200 period moving average, it did this. That time there was a double test to the bottom, but you can see that the follow through from 130 to 145, almost a little 11 or 12% move, and we've just started in this move. So that's really what remains to be seen. Can we get through this 145-ish and then up beyond 148? Channels now, small caps doing a little bit better than the larges, as you can see. Treasuries still looking positive. They've not been convinced yet that the equities have returned to normal. Gold put in a nice pullback and support level here after a bullish move up to 175. Just some reference charts now for the rest of the report. The fail stat and the signal to noise ratio and the z-score of various holding periods in a handful of the usual suspects. The z-score of the relative strength. Technology has started to recover here after the Apple sell-off. Oil finding support and going, but blended commodities and gold pulling back relative to the market in this past week of gains. And you can see that Europe has started to recover. EFA is has gotten back to parity here with the S&P. But meanwhile, this has been a U.S.-led bounce after the election. Let's see if it can regain the leadership. Safe zone channel and some gap statistics for a handful of topics of ETFs. Excuse me. Intraday range percentages and the quality scores for the Dow and the ETF 30. Pivots and the Elder Safe Zone channel. All right, that's the weekend report for December 1st. It's Ken Long of Tortoise Capital. Keep your powder dry and your risk measured.